Have you ever considered the silent expense that can subtly but significantly impact the profitability of your real estate investments, often overlooked until it is too late? Investors must absolutely account for vacancy rates as a primary operating expense when evaluating any property, treating it as an unavoidable cost that directly impacts their financial projections and potential returns. The core reason vacancy rates are so crucial lies in their direct impact on your property's net operating income, or NOI. JSON. Title: How should investors account for vacancy rates? Paragraphs. Have you ever considered the silent expense that can subtly but significantly impact the profitability of your real estate investments, often overlooked until it is too late? Investors must absolutely account for vacancy rates as a primary operating expense when evaluating any property, treating it as an unavoidable cost that directly impacts their financial projections and potential returns. The core reason vacancy rates are so crucial lies in their direct impact on your property's net operating income, or NOI. Vacancy represents not just lost rent, but also the costs associated with tenant turnover, such as cleaning, repairs, marketing, and agent fees. These rates are influenced by a myriad of factors, including local market demand, the specific property type, its condition and amenities, and broader economic conditions like employment rates. Understanding these variables helps you accurately forecast the period a unit might sit empty, directly affecting your cash flow. To effectively account for this, begin by researching historical vacancy rates for comparable properties in the immediate submarket. Look at data from multiple sources like local real estate boards, property management companies, and market research reports to establish a realistic baseline. Next, always apply a conservative estimate, often building in an additional 1 or 2 percentage points above the historical average as a safety buffer for unforeseen market shifts or extended turnover times. A sophisticated investor understands that underestimating vacancy can lead to a significant miscalculation of a property's effective gross income, which is your total potential income minus vacancy and credit losses. By performing a thorough pro forma analysis, you are not just predicting rent collection. You are integrating an informed projection of market absorption rates and tenant retention, ensuring your financial model reflects true operational realities. Proactively factoring in a realistic vacancy rate from the start empowers you to make more robust investment decisions, accurately assess risk, and set achievable financial goals. This diligent approach guards against unexpected cash flow shortages, ensuring your investment portfolio remains resilient and profitable in varying market conditions. Slides. Title: Unseen costs affecting returns. Bullets. Label: Silent expense. Sentence: Vacancy rates can subtly but significantly impact your real estate investment profitability if overlooked. Label: Primary expense. Sentence: Treat vacancy as a primary operating cost directly impacting financial projections and returns. Label: Avoid underestimation. Sentence: Failure to account for vacancy leads to miscalculated profits and potential cash flow issues. Title: Why vacancy impacts your NOI. Bullets. Label: Lost income. Sentence: Vacancy directly reduces your net operating income, impacting overall property profitability. Label: Hidden expenses. Sentence: Beyond lost rent, vacancy includes costs like cleaning, repairs, marketing, and agent fees. Label: Market factors. Sentence. Rates are influenced by local demand, property type, condition, and economic conditions. Title. Estimating vacancy rates accurately. Bullets. Label. Research history. Sentence. Research historical vacancy data for comparable properties in your specific submarket. Label. Multiple sources. Sentence. Use local real estate boards, property management companies, and market research reports. Label. Conservative buffer. Sentence. Add 1–2% to your estimate as a safety buffer for unexpected market changes. Title. Smart planning for resilient investments. Bullets. Label. Effective gross income. Sentence. Accurately calculate effective gross income by subtracting vacancy and credit losses. Label. Pro forma analysis. Sentence. Integrate market absorption and tenant retention into your financial model for realism. Label. Stronger decisions. Sentence. Proactive vacancy planning leads to robust investment decisions and a more resilient portfolio.